Heavy selling pressure for the US dollar. Is this going to continue as markets are ramping up their rate cut bets given the worsening economic data? Guys, Ken Chigbo back with another E8 Markets fundamental update. Let's jump straight into this. So the US dollar dropping to 4-month lows in the latest week on the back of worsening data in the United States. If you have a look here on the chart, this is a massive bearish candlestick, and we're going to look at things fundamentally in a moment. But if you just know, this trend line is key because it had been supporting the price to the upside since the commence of 2024. We've gone over it in the past videos. You know, within recent weeks, we've really slowed down on a couple of things: inflation cooling, also a dovish FOMC gearing the market up for rate cuts. And obviously now we've just breached this big area of demand at 104.00, a psychological number, which has made way for that fresh wave of downside pressure. Now, if we look at things fundamentally, we had every right for that selling pressure last week. Okay, really, obviously, as I say, intensified there on Friday. But when you look at the data for the United States in the latest week, we've seen a large softening, a tick higher in unemployment claims. Okay, the ISM manufacturing PMI in heavy contractory territory at 46.8. And then, of course, to round things off, average hourly earnings, this coming down to 0.2%, which is deflationary, right? If people are getting paid less, they're going to be, you know, we're not going to get as many people going out potentially and spending their money because wages are coming down. So that's deflationary. Of course, inflation comes down, right? The amount of jobs being added to the economy, only 114,000, large miss on expectations, and the previous even revised lower. And then the unemployment rate, 4.3%. This is the worst number we've seen. I think it was late 2021. Look, November 2021, we haven't seen a number this bad since late 2021. So we're getting a worsening in the labor market, which is also deflationary, and just concerns in general around the United States economy that we've got this economic downturn. Now, if you look here, markets are really ramping up their rate cut bets. They want a 50 basis point cut now after pricing in 25 basis point. They want 50 basis points in September. You can see here in November, 100% probability that they're going to cut there, you know, in November and again also in December. So really triggered by this worsening of data. And as I say, for the Dixie here, the next major demand zone is seen around this 102.70 area. Obviously, we're last here in March. If that gives way, then we're going to come all the way down, likely into to the back end of you know, these lows, the back end of 2023 at around this 101 area. So real downside volatility. Very likely given the worsening economic picture for the United States, and it's obviously going to give the dollar's peers an opportunity to capitalize on this weakness right now. Also expect plenty of volatility with the Australian dollar this week because we do have the Reserve Bank of Australia rate decision where they're expected to keep rates unchanged. Now, let me give you a bit of backstory with the RBA at the moment. Now, previously, they had actually left the door open at their previous rate decision to a potential rate hike. And the reason being was because inflation remained sticky in Australia. It was actually rising. Now, if you have a look here, the latest readings, inflation's come down, but I just want to show you previously where it had been rising. Look, been rising for 3 months there. But now we're seeing signs that it's slowing down, as you can see in these latest readings that we had at the back end of last month in July. Particularly here, if you look at the trimmed mean CPI quarter on quarter, dropping down to 0.8%. Now, given that low inflation data, markets have removed their pricing for a potential rate hike. And you can see the downside pressure that we've seen in the last few weeks with the Australian dollar really picking up some pace as markets gear towards a potential more dovish RBA now that inflation's starting to come down. And obviously, we've got concerns around the Chinese economy as well. We're seeing a bit of a slowdown in Chinese GDP. And obviously, China is Australia's biggest two-way trading partner. So Aussie dollar does look vulnerable. When you look at here on the weekly, as I say, we're in a clear downward trend. Next major weekly demand seen at around 64.50, and then we've got sort of 64.00. On a daily, we had this pennant forming, pennant, price action narrowing, and then a breakout to downside. Okay, we've broken out of that, and we've got a bit of a retest going on at the moment around this sort of 65.00 area. But price action does look is leaning towards further potential downside, even though obviously we know the volatility and the weakness with the dollar at the moment. But overall, this AUD weakness, if we do get a dovish RBA, could obviously outweigh the weakness that we're seeing in the US dollar, and this could continue to push to the downside. So do keep an eye on the RBA this week. Also expect some volatility as we do have key labor market figures from both New Zealand and also Canada. If we start off with New Zealand first, if you look here on Tuesday, we're expecting a worsening in the employment change, expecting minus 0.3% and the unemployment rates tick higher to 4.7%. Now, this is really important because if we get a further worsening in the labor market, remember that's deflationary, right? If we get a worsening in the labor market, we've got less people going out potentially that obviously getting paid in the workforce and obviously going out spending their money. There's less, right? If we're getting a worsening in those figures. So what does that mean for the central bank? It means potentially we could have a more dovish central bank at the next decision, i.e. the RBNZ turn a little bit more dovish. Markets at the moment are ramping up their rate cut bets for the RBNZ. They're probably one of the last with the RBA to actually look at cutting rates. But obviously this could force them quicker if we do get a worsening in these figures. Now, when we look at NZD, now keep in mind, obviously I always just go over the base case by looking at NZD versus the dollar. You can look at NZD versus other peers like GP NZD, Euro NZD, Aussie NZD. Pick your pairs wisely, okay? Because if we do get a worsening in the data, that will ramp up rate cut bets, and obviously we will see New Zealand dollar weakness. But when we look at obviously NZD versus USD here, obviously price action is actually at we caught decent demand. This is heavy, okay, very decent demand here. Let's remove that around this sort of just protecting the range of 59.00 towards 58.50, that 50 pip range. You can see there we'd bounce there in April, and again you can see that demand just go all the way along there. Now, obviously, if this data does disappoint, this could obviously go into free fall mode, okay? And as markets ramp up their rate cut bets from the RBNZ, you've got a next major zone. There's quite a lot of room for this to just drop if it does give way, okay? At this zone, I know at 59.00 towards sort of 58.50, and challenge these lows of 2022. Now, when you look on the daily here, okay, you can see, obviously, this is just the NZD taking advantage of the dollar weakness. Not to say that NZD fundamentals are any better as such, because also we have, similar to Australia, we've got that vulnerability to the Chinese economy as well. Remember, China, the likes of NZD, the likes of AUD, these economies are, and these currencies are commodity linked, right? So they're big commodity producers, and China's one of their biggest, or is their biggest two-way trading partner, both New Zealand and Australia. And where we've been getting a worsening in the Chinese economy, right? If you have a look here, I'm just going to show you on Forex Factory. I'm just going to show you these previous Chinese GDP figures. Bear with me one moment. So if you look at these previous Chinese GDP figures, awful, right? Last GDP figure dropped down to 4.7% there, right? From the previous of 4.3 and much lower than expected of 4. Right, 3, 2, 1. So if you look at the Chinese GDP here, okay, 3, 2, 1. So if you look at the Chinese GDP here, it actually came down to 4.7%. So we're seeing a worsening in growth in China. And as I say, that has an impact also on Australia and New Zealand. But back to NZD USD anyway, if that data does disappoint, we could obviously find rejections here, which we are at the moment, and this could end up playing out to the downside, something like that. And as I say, the next major demand zone after this sort of 59 area would mean coming all the way down to 56.00. But you never know, if we get a surprise to the upside, then you know where we're going. We're going to get sucked in towards sort of the mid 60 range. You can see where that next major zone is, as you can see here, look, from here to here. So it'd be the same sort of thing from here into that sort of mid 60 region. So keep an eye on that data. This is very important in shaping up the future expectations of RBNZ rate cut bets. And with Canada, its own jobs figures here, employment change and the unemployment rate. We've already seen the Bank of Canada cut rates twice, and they've left the door open to more rate cuts. And it does leave the Canadian dollar vulnerable to some further downside pressure. We have seen some underperformance with the Canadian dollar, with the general falling in commodity prices in recent times. If you look here at dollar CAD, I've spoken to you guys about this before, right? There's still, at the end of the day, there's still a divergence. Yes, the markets are ramping up rate cut bets from the FOMC, but the Bank of Canada have already cut twice, and they're going to be potentially cutting again in September. There's a massive divergence there. The FOMC haven't cut yet. So when you look here at dollar CAD, obviously price action was narrow for quite some time. You can see this monthly range. And now we're starting to see signs of a breakout. Remember, we've got this big pennant here where we're ranging. And then obviously I had this pennant within the pennant and a flag, which is broken out of. And now you can see this big demand zone, this big supply area at 158, which we're breaking down. And we could use this as new support, okay, new demand, and head to the upside. Now, guys, if you look left, right here in March 2020, you can see where we went to, right? Look at that free room there. Again, same thing here in 2016. Look at that. So in my eyes, if that divergence does expand, okay, and we continue to see the Bank of Canada cutting much faster than the FOMC, bear in mind the FOMC hasn't cut yet, this could be only heading one way, especially if we get that economic downturn and commodities tend to get hit harder. And obviously CAD is commodity linked currency. This could obviously be well and truly heading into that 146 territory. So as always, plenty of talking points and volatility expected in this trading week. Other than that, guys, have a blessed one and I'll catch you on the next video.